If I look at my wallet of shame from when I've allowed myself to FOMO in on stuff, I allow myself up to 10% of my portfolio to do that. I probably never even get to 10% because it's just not my comfort zone. If I look at it, every single trade I did lost money. I think I've lost near 100% in smoking chicken fish, which was like one of the memes that I held, and I had a reasonable sized position in it. And I thought, I can't get out of it because it's just going to nuke the market anyway. So I wrote it up, wrote it down. But, I treat it like a call option. I knew it was the highest probability chance it was going to be a zero. But, you also don't really understand markets until you participate in the elements of it. Yes. You need to get a feel for what it's about to understand what memes are about, how DeFi works, that kind of stuff. So to have a bit of capital that you're going to nuke to learn is a very good thing to do.
The crypto market remains one of the greatest wealth-generating opportunities of our lifetime. Few asset classes combine exponential technology, network effects, institutional adoption, and global liquidity cycles the way digital assets do. But with that potential comes real risk, not just for retail traders, but even for the smartest macro investors. No one understands that duality better than Raoul, who has built an entire framework around navigating this space. Even so, crypto has humbled him more than once. A recent example. He invested in smoking chicken fish, a memecoin he genuinely liked and believed in, only to lose 100% of his money. No excuses, no metaphors, just a reminder that in crypto, even smart people get it wrong, not from recklessness, but because the risk curve is unforgiving. That's why Raoul sticks to his core rules. Avoid leverage, ignore FOMO, size positions properly, keep 90% of capital in high network value assets, and treat meme plays as pure entertainment money. His chicken fish loss perfectly illustrates why these rules matter more than conviction. But Raoul's story isn't just about mistakes, it's about clarity. His loss reflects what's happening across the broader market. Liquidity has tightened, sentiment has cracked, and the most speculative corners, altcoins and memes, have been obliterated long before a true bull cycle begins. We haven't yet seen the broad-based rally that defines a full cycle. Instead, there are pockets of excitement followed by violent corrections, all driven by macro forces most investors overlook. In today's video, Raoul explains why the market is behaving this way, what's suppressing risk assets, and what needs to change before altcoins and memes can meaningfully run.
At DailyDoseCrypto, we officially partnered with BTCC, a rock-solid exchange with 13+ years of regulated, proven performance across the US, Canada, and Europe. BTCC gives you up to 500 times leverage, super low fees, deep liquidity, lightning-fast execution, and copy trading if you're just getting started. And for our community only, the perks are massive. A 10% deposit bonus up to a 10,000 US, extra free rebates, private giveaways, monthly competitions with big rewards, bonus multipliers for high volume traders, and early access to new features. This is why DailyDoseCrypto is teaming up with BTCC to level up your trading. Hit the link below and get started ASAP.
There seems to be quite a lot going on, but nobody can explain it. There's, where we are today. What day are we? We're on the 20th of November talking today, and market's puking. And it's been in that weak trend. I've been looking at this for a while, and there is this mismatch of liquidity that's happening at a macro level that's causing a lot of the issues we're seeing right now. And that is, without getting in too deeply into the weeds of it, basically, because of the government shutdown, the Treasury built up its general account and has not been able to really drain it yet. And there's no offsetting buffer because the reverse repo's drained and we've got QT going on. So we've got this kind of sucking of liquidity out of the system that really has affected the highest risk assets further out the curve, and crypto is that. Technology has been kind of volatile because of the same reason, but it's been held up somewhat by buybacks and also held up by the generally, I think 80% of all fund managers were below benchmark because they've missed tech, because all the way through they said tech's a bubble, AI's a bubble, AI's a bubble, and they've missed the whole move. And so that's dramatically affected performance. So they've been performance chasing, which kind of meant that NASDAQ outperformed for a period of time. But it's this liquidity thing. Liquidity, we found in our work at Global Macro Investor, using the total global liquidity explains 95% or 97% of NASDAQ's price movements over time since 2012 and 90% of Bitcoin's. So it is the single most dominant macro factor, and most of the explanations lie therein. So on the macro side, the business cycle, which is the main kind of driver of everything, has been very subdued for this entire cycle. And that's been driven by the high rates environment and the liquidity environment. If you, on a forward-looking basis, understanding all of the fiscal stimulus that's coming, plus liquidity stimulus that's coming, and the probability of rate cuts coming, the chances are the business cycle is going to be a lot stronger going into the election year. Don't forget, we've got Scott Bessent running the Treasury. He's an ex-hedge fund manager. He understands this game very well. So I think on a forward-looking basis, it looks great. But what you've got is this liquidity air pocket that means that there's not as much money around. The people's propensity to take money off the table is higher. People are nervous. I mean, we've seen the fear index in equities be down at like 8, which is insane considering the market's barely off the highs. So it shows you there's some pervasive sense of fear. And so any movement in the market kind of gets exaggerated very quickly. And I think, after the NVIDIA earnings, people just want to quickly take money off the table. And as you say, next week's a US holiday week. Things start calming down as well. And if you've had a decent year, you do want to protect it. Yeah. But normally, end of the year is usually pretty strong. And considering they've got to drain somewhat of the TGA to pay for all of the employees they furloughed, et cetera, there's a reasonable amount of liquidity that will come into the economy over year end.
Do you worry about that? Is crypto just reacting before and ahead of the stock market, or is there something more kind of specific to the asset class?
No, I mean, crypto, there's 2 different levels. One is, go back to its liquidity. So liquidity has hit crypto more than anything else. And that is the Fed net liquidity that has shrunk. So it's hit that. But then we've got OG profit taking we've seen. So that continues. And that kind of makes sense. And you've got this pervasive opinion that the 4-year cycle is what it is. And therefore you must sell in November and go, October, November, and go away and come back in, 12 months time. So there's that pervasive feeling. And then there's, I think, somewhere there is some damage that was done during the October the 10th flash crash in crypto. I don't know if there's a body there, but my guess is the balance sheets of some of the market makers are impaired. So it means that they can't provide as much liquidity as they have done, which exaggerates price moves. I think that probably makes sense. We're also seeing some unwinding of the token holdings by the DATs because of the construct that they've got. They buy back their equity. So, that's ugly, and that will probably continue if price action continues like this. So you've got this supply going on, less liquidity around because of the Federal Reserve and the Treasury, and less liquidity in markets because of impairment after October 10th. Makes it just feel not great.
Being in crypto, is it just only Bitcoin? Is there a room in a portfolio for alt and something else, or is it just not the right time to be going out and far on the risk spectrum?
So for me, it depends on your time horizon. I mean, I don't look at it in year-to-year gains. You look at it full cycle gains. Full cycle for me is the business cycle. So it's not necessarily the 4-year Bitcoin cycle. So you look at the gains over the cycle, and over time they compound. So here we've had a year which has been pretty lackluster. It's gone nowhere at Bitcoin level. But at Bitcoin level means that everything below that has underperformed. And I get it. It feels terrible. I've been lucky enough most of the way through. I mean, I haven't been in Bitcoin all cycle. I've managed to outperform it via just having the right asset allocation. Bought Solana at the lows and then switched into Sui when it had its run. And it's given a bit back. But generally, that's worked fine. I'm not a big fan of going too far out the risk curve. I have this whole don't this up thesis. And a lot of it is every time you think you're really being smart out the risk curve, your probability of success is pretty small. So I tend to stick with layer ones generally because it's definable. I understand the metrics, I understand what drives them. And then, if I look at my wallet of shame from when I've allowed myself to FOMO in on stuff. I allow myself up to 10% of my portfolio to do that. I probably never even get to 10% because it's just not my comfort zone. If I look at it, every single trade I did lost money.
What's been your worst trade?
I I think I've lost near 100% in smoking chicken fish, which was like one of the memes that I held, and I had a reasonable sized position in it. And I thought, I can't get out of it because it's just going to nuke the market anyway. So I wrote it up, wrote it down. But, I treat it like a call option. I knew it was the highest probability chance it was going to be a zero. But, you also don't really understand markets until you participate in the elements of it. Yes. You need to get a feel for what it's about to understand what memes are about, how DeFi works, that kind of stuff. So to have a bit of capital that you're going to nuke to learn is a very good thing to do. Yeah. The real key thing, and I tell everybody to do this, is like, that should only be 10% or less. Then it doesn't matter, and just leave the rest to do its thing.
Raoul's breakdown makes one thing clear. The volatility we're seeing isn't random, it's structural. The market is moving through a temporary liquidity vacuum caused by the government shutdown, Treasury general account buildup, drained reverse repos, and ongoing quantitative tightening. Simply put, money hasn't flowed into the system like it usually does. When liquidity tightens, the riskiest assets, especially crypto, get hit first and hardest. But here's what many investors miss. Despite the short-term stress, Raoul argues the forward-looking environment is actually setting up for strength. Fiscal stimulus is rising, liquidity injections are on the way, and rate cuts are increasingly likely as we approach the election year. Fear is unusually high, even with markets near all-time highs, a combination that can exaggerate small moves and trigger unnecessary panic selling. In crypto specifically, liquidity has weighed on prices, OGs have taken profits, and events like the October flash crash likely reduced market maker capacity and order book depth. Yet the structural drivers of long-term adoption remain intact. Raoul emphasizes that the real signal comes from the business cycle, not the 4-year halving cycle that retail traders obsess over. That raises the key question. If liquidity is the dominant macro force and the next major cycle hasn't bottomed yet, should investors expect more violent drawdowns? That's exactly what Raoul addresses next.
Those drawdowns, again, are driven by liquidity, and Bitcoin is crypto is the most affected by liquidity of all of the risk spectrum of assets. So it tends to go down. It's also an earlier stage, network adoption model, like Amazon went down 95% in its first cycle, stuff like that. Over time, networks, as they get adopted, have less volatility because there's more economic activity and less, and it tends to be stickier over time. So my guess is the next time we have the liquidity down cycle, which I think is more likely to be 2027, we will see less of a drawdown in Bitcoin than it was previous cycle. And we've seen that pretty much every cycle, that it's had less of a drawdown. My first cycle, I think Bitcoin was down 87.5% back in 2013. And then it was down less in the next cycle in 2018, whatever. So it kind of fits to me that over time. But when you go further out the risk curve, so if you've got a newer token that's smaller, it's going to fall 90%, as they always do. So I don't think that changes anytime soon. It's just the question is are we starting it now, which is what some people think, because they think that the 4-year cycle in crypto is the most dominant factor. And I would say, no, it's driven by the debt refinancing cycle. So it's just two different ways of looking at it. And, from what I can see, we've got 10 trillion of debt to roll over the next 12 months. If you're rolling 10 trillion of debt, you're going to need some liquidity to do it. So in which case, it's hard for the market to go down.
What you're saying is it's a business cycle. Don't overcomplicate it. If you believe that's going to continue to be strong, crypto should continue to be strong. And
at basic level, yeah. If the business cycle's okay, crypto's going to be okay. And if they're tightening conditions, the Fed usually tell you, like, we're going to tighten rates. It's usually a pretty good flag that liquidity is going to come out of the system. So, you can keep it as simple as that.
How often do you reposition your portfolio on the margin?
The last time I changed an asset allocation in my own personal portfolio was 2024 when I switched Solana for Sui.
Mm-hmm.
And then I'd done any other trade since then. I've added risk or added money into the trades, but no, I barely trade. The other side of the equation is I've spent a lot of money allocating to digital art, which is a long-term investment thesis of mine. So once, when crypto prices are strong, I take some money off the table, put it into long-term art holdings, which I think are going to be an interesting longer-term investment. That's like a 10-year bucket. But so, yeah, I really, really don't trade. Yeah. I used to. I ran a giant hedge fund and I traded a lot. And I realized when I set up Global Macro Investor back in 2005, the reason I left the hedge fund industry was because it made no sense to be using a monthly P&L to trade macro risks, which are by definition several years.
Yeah.
And so I went to prove that is the case, and it's proven to be the case, that you just extend your business cycle and marry it, your investment horizon, and marry it with a business cycle, your returns compound. Or if you're in a strong secular trend, you don't do anything except buy when the market goes down. So my journey in this is a decent journey, which was when I first did it, I had a decent sized bet in 2013 when Bitcoin was 200, and I wrote the first kind of macro strategy piece on how to value Bitcoin back then. It was a decent size, but not that big. So, and I wrote it off and said, listen, this is a highly speculative asset. It could go to zero or it could go to $100,000. And that was my thesis back then. And it went up 10x, then fell 87.5%. And, I wasn't phased because it's like, I'm in this trade for an extended period of time. I ended up selling out in 2017 and then saw the downside of the cycle. And then by the time I got back in again in 2020, I grew my position size significantly. So it was a much larger part of my liquid net worth. And then by the time we got to 2022 lows, I'd then gone to pretty much 100% of my liquid net worth because I'd learned how to manage the volatility psychologically. I also have cash flows because I have businesses that generate cash flows for me that allow me not to require the use of that capital in short term. That's what's happening to people, is their time horizon shrinking and their need and desire for instant gratification is increasing because it's becoming harder and harder to buy a house or to have kids or do anything, right? So it's really shrunk people's time horizons and the instant gratification, which is why leverage and speculation are becoming a normal part of life now for most people. And so that makes it very hard to have conviction in something where you actually need the money to put a deposit on a house or down payment on a house or whatever it is. So you can't be risking all of that. So yeah, I own my houses, so I don't need to worry about that. So I'm in a stronger position. I get it. Mm-hmm. So you're either young, just extend your time horizon, just keep piling money into it over time. Or if not, you have to shrink your trade size if you can't sleep at night. Yeah. I mean, nobody likes it when their portfolio goes down 50%. But, if you're in crypto, you better get used to it because it's part of it. And as long as you're not too far out the risk curve, you basically have to say, is this thing I'm investing in, this network, is it going to survive? Does it have Lindy effects? And is it likely to grow over time? Yeah. If you can honestly answer that and prove it by showing some work that you've done that the network is vibrant, then you'll do fine. Yep. But most people don't do any of that stuff. They just hear a tip on Twitter or YouTube and end up buying some token because somebody once said this can go to the moon. Primary importance is it always is. And then you want to cover your Maslow's hierarchy of needs at first. Make sure you can afford somewhere to live. And then depending where you are in your life, that percentage of your earnings that you put into your investments.
Bitcoin has climbed back above $90,000, tracking a broader risk-on shift in equities driven by tech and AI optimism. Correlation with the S&P 500 reached around 0.87, showing Bitcoin isn't decoupled from macro markets. Equity catalysts can quickly drive crypto rallies and reversals. Markets are also pricing in a potential Fed rate cut, which could boost liquidity, risk appetite, and flows into both stocks and crypto. Raoul Pal's framework highlights that liquidity is the key macro driver. When it tightens, risk assets suffer. When it expands, they can surge. Early signs of liquidity returning have already lifted prices off recent lows. Pal's full loss on the smoking chicken fish memecoin is a reminder that liquidity alone isn't enough. Risky assets remain volatile, so the safest approach is holding high network value assets like Bitcoin and Ethereum, while treating alts and memes as small speculative bet. His rules, no leverage, no FOMO, no oversized positions, remain essential. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.